As a real estate strategist, listen to the Bank of Canada's timely guidance on the state of the economy and personally spot check the producer price index for housing, industrial raw materials, machinery and equipment, and related services as leading indicators for future inflation. Hi, my name is Mel GIANNONE. I'm a commercial real estate broker serving entrepreneurial companies and individual investors seeking property across the Greater Toronto Area. Welcome to CRE Next, Work Out Loud. Here's what happened this week in CRE. Hello everyone, welcome back to another latest edition of CRE Next, Work Out Loud. My name is Mel GIANNONE. I'm your host for these episodes that share my everyday work thoughts on real estate out loud with you. These are episodes targeting commercial real estate strategists seeking insight into the current commercial real estate market for the Greater Toronto Area. So if you play a real estate role for your company or transact in commercial real estate personally, then I invite you to help grow this online community with me. Let's work out loud together. I appreciate you spending some time with me today. This week in CRE, I want to share with you some insights on the top 5 issues and trends we feel are affecting commercial real estate today. You can read the full top 10 list in a blog I've written and posted on our website under the media section. While you're there, subscribe to our free monthly newsletter for our clients called the Prep Sheet, an acronym abbreviating the name of our company, Paramount Real Estate Properties. You can sign up on the homepage of our website at paramountrealestate.ca. If you find any value from our episodes, we welcome your comments, likes, and encourage you to subscribe and tap that notification bell so that you don't miss out on any new content as soon as it's released. Lastly, if you know of anyone who could be interested or benefit from these episodes, please feel free to share the link with them. I can also be found on other social media channels like Facebook, Instagram, Twitter, and LinkedIn, as well as in audio podcast versions of the show called CRE Next, Work Out Loud. I look forward to connecting with you on these platforms as well. All right, let's get into this week's episode. No doubt, the COVID-19 health crisis was and still remains a generational changing event, having tremendous influence on how we value, acquire, and use certain classes of real estate for business. Each crisis in history has been an accelerator event that amplifies existing trends and brings forward forecasted future trends into the present. This accelerated transformation ushers in new opportunities for wealth creation while disrupting older business models, rendering them obsolete. Let me elaborate on this point a little bit to demonstrate what factors real estate strategists should be focused on to help navigate current headwinds and uncover some potential opportunities. Here now are the top 5 issues and trends we feel are affecting decision-making in commercial real estate today. Issue number 1, interest rates. We shouldn't be as concerned with the rising cost of borrowing funds, but rather the speed in which the Bank of Canada could raise rates based on whether transitory inflation becomes prolonged hyperinflation. If not handled with surgical precision, the nation could slide into economic stagflation, where costs rise while employment levels stagnate or fall. Since the Consumer Price Index is a lagging indicator, it may take months to determine whether runaway inflation has taken hold. The threat to the economy is that too much delay could force the Bank of Canada to overreact and apply a steep rate hike in order to get ahead of that trend. Too steep, too soon of an interest rate hike would shock the system back into a recession and potentially bring about defaults in the lending market. As a real estate strategist, listen to the Bank of Canada's timely guidance on the state of the economy and personally spot check the producer price index for housing, industrial raw materials, machinery and equipment, and related services as leading indicators for future inflation. Point number 2, inflation. Monetary inflation refers to the increase in the nation's money supply. Inflation strategy involves increasing the amount of dollars in circulation through the creation or printing of money, be it paper money or digital currency. The intention of this strategy is to create liquidity in the markets via the dealer banks, government transfers directly to Canadians, or government investment spending, to name a few ways. The money supply in Canada had increased over 17% in 1 year since the start of the COVID crisis back in March of 2020. The immediate accumulating effects of introducing all this monetary and fiscal stimulus is that aggregate demand temporarily spikes up prices and places upward pressure on production costs until supply can catch up. As real estate strategists, we need to pay attention to the stresses experienced in the supply chain infrastructure for construction and operations. According to development cost consultancy firm Finnegan Marshall, high-rise construction costs have soared in the GTA, jumping as high as 53% over the past 5 years. Factors such as concrete forming, rebar, glazing, HVAC, drywall, and other building materials have escalated alongside land costs, development charges, lot servicing charges, and school board levies. These factors coincide with other operational elements like the implications from Section 37 of the Planning Act that refers to community benefit agreements committed by owners and developers in exchange for approvals. Lastly, one of the most alarming factors relates to the severe undersupply of available skilled trade workers that are being courted for competing jobs in the industrial asset class, purpose-built apartment class, ground-level residential, and more generally, all the infrastructure projects introduced by all 3 levels of government. All in all, over the past 5 years, hard costs have grown by about 53%, soft costs at 68%, and land costs at approximately 140%. So on a blended basis, project costs across the board are up about 76%. Point number 3, price discovery and underwriting. When we look back at the last 15 months, the Bank of Canada's participation in the debt markets have clouded the ability to determine opportunity costs between different assets and investment vehicles. The debt market hasn't been a reliable guide for measuring risk. The Bank of Canada's policy of purchasing government bonds and corporate debt have artificially suppressed investment yields, causing some difficulty in measuring risk and volatility in risk premium spreads. Without the public, institutional, and private equity capital investors providing the markets with clarity on valuation and pricing, then the large majority of real estate investors remain cautious and refrain from fully participating in the investment for commercial real estate. That slack in transaction activity results in a limited source of deal comparables available to benchmark underwriting. Uncertainty about how to underwrite net operating income for a property has been a source of frustration due to an inability to anticipate when occupancy and rent will rise for certain asset classes like office and retail. However, the uncertainty is subsiding, especially for industrial and purpose-built apartments, as shown by the increase in deals completed throughout the first half of this year. In fact, we only need to look at the U.S. market for a glimpse into the future of investment demand for commercial real estate here in our own market. The U.S. is almost 2 quarters ahead of Canada in reopening their economy. REIT values, or real estate investment trust values, have already recovered back to pre-pandemic levels over there. For now, investors in Canada are placing greater importance on tenant quality, length of remaining lease terms, and building occupancy levels for determining value until a sustained open economy is reached. Their focus has been on things they can control, like retaining tenants, defending cash flow, and forcing appreciation through capital improvements. Those entrepreneurial private investors that can get out in front of the larger, more conservative institutional investors will be rewarded with the most lift in asset appreciation. So now is a good time to get out there and test the waters while there are fewer players in the market. Borrowing costs remain low, and rising replacement costs start creeping into future pricing. Price discovery across all markets will become less elusive as the Bank of Canada cautiously tapers its purchases going forward, currently standing at $2 billion per week. As real estate strategists, we need to keep an eye out for steep jumps in yields for short-term debt as the Bank of Canada hands off purchases back to the free market, while they focus on the longer end of the yield curve to keep interest rates and borrowing costs reasonably low for the distant future. Point number 4, new work controls and processes. Changes in real estate lags the larger economy in its response to new patterns and behaviors adopted throughout this COVID-19 crisis. Determining which behavioral changes make up part of the new normal will help us better predict which real estate assets will have the most potential upside for profitability. For those with existing assets, understanding these economic structural changes will help reposition properties for more street appeal amongst prospective tenants. Demand will be defined by the extent to which this crisis leads us to abandon old habits and adopt new ones. And value creation will be driven through risk management, generating trust, and increasing utilization of space. In this current environment, here are some real estate implications for us to consider, like the costs associated with ongoing health, wellness, and safety concerns for re-entry into the workplace. Reevaluating workplace density, space optimization, and new configurations, now accounting for employees that will continue to work from home, satellite offices, or virtual offices from anywhere. These days we must consider the adoption of prop tech, property technology to manage risk and control operating costs for property, which may include upgrades to connectivity, security, cybersecurity, and other hosted processes requiring huge broadband capacity for tracking the traffic of people in buildings, operating contactless doors and elevators, air and quality monitoring, or airflow and recirculation of air. All are critical components that make up ESG, environmental, social, and governance. These initiatives are attracting green tenants and institutional investors by aligning with their climate change and carbon footprint goals. Here is one more. Strengthening supply chain infrastructure, equipped for the growing digital economy, upgraded or modernized real estate facilities that are energy efficient, support new inventory models, distribution and delivery systems, automation and information systems for last mile deliveries to homes and businesses that would be most prized and sought after by tenants and investors. We have entered an era in which we are less dependent on bricks and mortar stores and more on e-commerce warehouses that will be increasingly automated and less reliant on labor. Charging stations for electric delivery vehicles, taller clear heights for racking, second-story mezzanines, increased number of shipping doors, secured shipping yards, redundant power supplies, connections to rail, and close proximity to highways and urban centers will be most appealing. And lastly, point number 5, but most relevant to the everyday consumer, is the advent of artificial intelligence and the institutionalization of residential real estate. Sounds scary, huh? With global interest rates and yields so low, large investment funds are looking for higher returns than they can get in the bond market, while benefiting from the conservative safety of an asset class like single-family homes. Recently, technology has disrupted the residential housing industry. Artificial intelligence has allowed for the introduction of iBuyers and corporations to make instant cash offers on homes to sell them soon after for profit. Now, institutional investors who have used artificial intelligence to navigate the equity markets are coming onto the scene in a big way. Pension funds, foreign sovereign wealth funds, private equity firms, insurance companies, and hedge funds are all chasing profits through these means, soon to be competing with ordinary Canadians for the purchase of a home and renters for their investment properties. With a larger institutional presence, an already tight housing market could grow tighter. Single-family rental companies can overshadow smaller buyers by offering all-cash deals and more aggressive approaches to completing the sale, like no conditions and quick closings. Up to now, individuals never crossed paths with competing institutional investors when buying a single-family home, but now demand for ground-level single-family rentals has been driven by changes influenced by baby boomers and millennials and accelerated through conditions in the market during this COVID crisis. The shift has altered migration from urban to suburban locations, high-rise to low-rise properties, trading up from micro-apartments to spacious ground floor dwellings with outdoor living spaces. Tighter mortgage rules, affordability constraints, increased construction costs, and a more transient lifestyle preferred by Canada's growing population are all factors contributing to the increase of demand for rental housing. Coming out of the fallout of the great financial crisis of 2008, U.S. institutional buyers were increasingly involved with buying large numbers of foreclosed homes at deeply discounted rates and then leased them back as single-family homes to tenants who had lost the ability to keep ownership of their own homes. The yield on renting those units were better than the yield generated out of multifamily assets. The focus was typically for projects and subdivisions numbering over 50 units, usually found in retirement communities like in Arizona or Florida. Corporations like BlackRock would buy entire subdivisions back then, which gave way to the likes of JP Morgan, Blackstone, Cerberus Capital Management, Colony Capital, and Starwood Waypoint as the single-family rental market grew. In Canada recently, Core Development Group's sister company named Avenue had announced an ambitious pilot project in March this year. The goal was to purchase $1 billion worth of single-family homes for rentals by 2026. Starting with 8 markets in Ontario, the company intends to purchase at a clip of 15 homes per month before expanding into Quebec, British Columbia, and Atlantic Canada. Through the use of proprietary technology, they would apply algorithms to rate the homes, markets, and areas in which they wish to acquire. Should the house and neighborhood meet the acquisition criteria, an offer can be made within a few minutes of it being listed. The goal was to target no less than a 15% net profit on its rentals. The fear here is that any home that goes into an investor's portfolio isn't just about taking housing units out of the supply stock, but rather locking up that home out of potential home ownership for decades to come. There is a concern that as more institutional investment floods this industry, prices for homes would further inflate, making it harder for Canadians to buy a family home of their own, and force some families into remaining in institutional rentals instead of building wealth. The flip side to these arguments would be that the types of homes Core is buying consists of those in a great state of disrepair. Splitting these houses into 2 units would thereby increase housing inventory, providing affordable and safe alternatives for residents to live in with their families, and bringing a professional institutional management style to the rental market for a better overall experience. I'd like to hear what you have to think about this latest contentious issue. Is it a trend we should be concerned about, or an opportunity for commercial real estate investors. Hey, if you want to learn 5 more trends and issues affecting real estate today, visit our website at paramountrealestate.ca. I've written a top 10 blog post with additional points for you to consider. Look for it under the media section, and while you're there, subscribe to our free monthly client newsletter called The Prep Sheet. You can sign up on our homepage of our website at paramountrealestate.ca.